to another episode of Financial Minds. I'm Jamie Agostino, your host. The Federal Reserve meeting is next week. What will the Fed do next, and what impact will it have for credit unions? Let's find out. Joining me today for this discussion are Tim Sustak, SVP Chief Treasury Officer, and Scott Wood, SVP Chief Investment Officer with Vizo Financial. Let's start by talking, taking an economic pulse before we get into policy and strategy. So, Scott, I'm going to start with you. I believe we have some reports going into next week's Fed meeting. What will the Fed be looking at prior to next week?
Yeah, we will have some reports. So let's, I guess, start off from where we stand today. Really, with the government shutdown, a lot of the reports have been delayed. Some of the data won't be recoverable. They'll be missing aspects if they try to do it, or some of it is just going to be delayed by a month or more even. So some of the employment reports that we would have gotten, I think the last one we got out was September, relatively recently. We'll get the next one here, but it's going to be after the FOMC meets, so it's going to be late. It's going to be a week later. So it's not going to tell them a whole lot because they can't see it, and that's the problem, right? We have all this delayed data that the Fed was looking at, inflation and employment data, which will help guide their decision because they're very data dependent at this point. The Fed is very split at this point. So the more data we have, the better for the Fed. The more informed decision they can make, the better their discussion will be because they can say, hey, the economic data, the most recent economic data we just looked at is showing us this or that. And that's the problem because the data has been delayed due to the shutdown. It gives both camps, the camp that's concerned more about inflation and the camp that's concerned more about a weakening labor market. They both have ammunition going in because there's no recent clear data to add further clarification, I guess, to the employment situation. But we will have some data. We're going to have some stale data on the employment side of things as far as the official government report goes, but they can also look at private data. So they can look at things like the ADP report, which weren't delayed because it's not government data. But the problem is there's not a one-to-one correlation between ADP and the government's job report. It over time, the two sync up pretty well, but on a monthly basis, they don't sync up really at all. So so that's a little bit of a concern, but they'll look at that. They'll look at some of the inflation data that they have. So there is some inflation data, probably a little bit more of that than there is of employment data to look at, but still it's another one of those things where some of that data is missing. But that's continuing to be their focus. And if you listen to comments from the different FOMC members, that's really what they're looking at right now. And what has them split is the whole inflation controlling, prices versus maximum employment. The Fed's in a really tough situation. The government shutdown certainly has not helped matters out at all, but they'll look at that data. The other thing that they have to look at is consumer spending. So there's a lot of private data in that area to see how well the consumer's holding up, and that's a big thing right now. Even if things are weakening on the labor front, if consumers are still spending, that shows a level of confidence anyway that maybe they feel secure in their job. Maybe they're just like, well, it's the holidays, it's Christmas or Hanukkah or whatever holiday you celebrate. We're going to spend anyway. That could be the part of it, but we've seen credit card debt hasn't really been climbing a tremendous amount, but MasterCard came out with a report yesterday and they showed that Black Friday shopping, at least their initial numbers, are above where we were last year. So that's a positive sign for the Fed that the consumer seems to be, somehow the consumer is still hanging in there with all the headwinds that they're facing. They're still hanging in there. So that's a positive sign for the Fed. So they'll look at things like that too. So,
Okay.
But I think the lack of data will definitely make it a challenging meeting as far as the decision goes.
Yeah. Well, to your point with consumer spending, I was just in New York City this past weekend, and I'm going to say consumers were definitely spending. The stores were packed. There were lines to get into several of the stores, and the streets were packed. So everyone's out and getting ready to do their holiday shopping.
Yeah, we hear a lot of stories of the struggles, but the consumer has shown a lot of resilience over the last, I would say, 2 or 3 or 4 years, even as prices have climbed, and they've been a lot more resilient than maybe I think the the markets would have thought. And so that's a good thing, as long as debt is not going crazy. And I think it's
Sure.
kind of maintained a relatively stable level. So that's positive.
All right. So, Tim, based on what we do know, will the Fed cut rates next week? Why or why not?
I wish you'd asked Scott this one because you heard what Scott talked about, and the answer is who knows, really. It's as Scott said, it's really difficult, right? I mean, you're in a situation where they always say the two sides of the mandate or intention, right? So you have that, and you have this period where you're lacking data. You could probably make a good argument either way. A few weeks ago, I would have said I don't think they're going to raise. Now I'm kind of leading to the camp that yeah, I think they're going to do 25. And I just one of the things honestly that swayed me is Fed New York President John Williams came out and seemed to indicate that he was in favor of another cut. The Fed New York Bank president, permanent voting member, that person always holds some sway, obviously. And I just kind of feel like, you know, the concern over inflation has been tariffs, right? Are tariffs going to take hold? Are they going to run up inflation? I mean, we haven't really seen that. Now, granted, we don't have a lot of current data, but from the data that we do have, the sky is certainly not falling there. Um, and in my head, if you're willing to do it, the past two meetings, um, I would think based on what you know at this point, the markets, at least yesterday, I want to say they were mid 80-ish% expecting a cut. It certainly is divided. I mean, it could go either way. But like I say, Williams came out in favor. I saw JP Morgan change their forecast yesterday. Now they believe that there's going to be a cut coming out. I mean, they're certainly plugged in. So I am leaning towards a 25 basis point cut. And then, you got to catch up on this data, see where you're at, and then make a play from there. Maybe you pause going into 26 and see what happens. Depends what goes on here over the holiday season. I mean, to Scott's point, and your point as well, it's certainly gotten off to a good start. I guess the question is, and this gets kind of deeper into it, but we've been talking about the bifurcated economy for a long time, and I think that's even more and more becoming the case where, yeah, the consumer spending, but what consumer? There's increasing evidence to say that the haves and have-nots are becoming more split, and the haves are driving the economy. And unfortunately, it seems like the haves can drive the economy to the point that at some level, statistically, the have-nots don't matter as much anymore, which is kind of a dangerous point to be in, I think. We'll see how that plays out. But that's some of what I've been reading is, statistically, the have-nots just don't show up as much. So, consumer spending, yeah, hey, there's a lot of folks that are doing well, but there's a lot of folks that aren't either. And I just think that they are getting increasingly missed in the data and the commentary. But, I'm going for 25 bips.
Okay.
We'll see what happens.
All right. So, Scott, if you had to outline three economic scenarios, soft landing, mild recession, or renewed inflation, how would each shape the strategic priorities for credit unions?
Yeah, and I think at this point in time, as Tim and I have talked about this morning, probably any of those, or you could make the case for any of those. As we mentioned, the resilient consumer, positive. As the other part that Tim pointed out was the bifurcation, right? This K-shaped recovery that we hear about, that there's a group that are spending like there's no tomorrow. They've got plenty of money, and then there's a group that's struggling. But what I find interesting is when you look at consumer sentiment, it's been very negative for the past year or so, or even longer. Um, but the actual consumer spending doesn't match up to what the sentiment is. So we hear all this negativity by how consumers are feeling, but we don't see it right now in the data. I don't see it when I go out, as you talked about in New York. busy, busy, busy. When I go out around town in Greensboro, people are still eating out. Restaurants are packed, the sit-down restaurants and things like that. So people are traveling. There may be a slowdown in some of that. I haven't flown in the last month or so. So maybe I do fly out here in a week or so. I'll be curious to see what the airports look like. But yeah, it's obviously the soft landing would be the ideal situation. If we can hit a soft landing, we're all happy. Credit unions can continue to lend out. Consumers, their members will continue to borrow money. They should be in good financial shape. They'll be able to continue to pay their bills. Delinquencies and so things like that will be, minimal. Would be the hope if we hit a soft landing. So that's good news for the credit unions. They can continue to make loans. They should continue to see deposits hold up pretty well to fund those loans. And those are things that we've been seeing here recently. We kind of see indications that we're either in a soft landing or hit it, but we're not at the end of this cycle. So the other one you talked about was maybe a mild recession. And if it's mild, I would say something similar. Not a horrible thing for credit unions. Certainly there'll be a slowdown with lending. So their strategy of auto lending and things like that they may not hit targets, but it may mean that they may need to transition to deploy that money. Maybe they're investing that into the bond market a little bit more than they would versus member loans. But again, a mild recession wouldn't be terrible. Where it becomes an issue is if we hit a more severe recession, and hopefully we don't get to that point. But a mild recession, very manageable for credit unions. Those generally speaking, when we see recessions, even on the mild end, they're going to see deposits, their shares are going to increase because their members are going to start to see, either a friend or a neighbor losing their job, and they'll start to tighten up a little bit. So they'll see, they should see shares increase. Lending would come down some. So then it will switch to some other way to make money for them. If we hit the high inflation, that's certainly a concern because the consumer is already struggling with high prices. When you look at a lot of the concerns that consumers have when we look at these recent elections on a national level, that's one of the things they cite a lot as higher prices. Um, so, to get prices to come down from that 9% inflation we had of a few years ago is you have to have deflation. And obviously we're not having deflation. We still have inflation. It's just at a lower level. If inflation were to rear its ugly head again, above, let's say we're floating around 3% now, but if we started to climb to, 4.5%, that's certainly going to crimp the consumer. It's going to give them less money to borrow. I've heard stories here. I pay a lot of attention to new and used car markets to see how consumers are doing. And there's been a lot of talk here recently in the last month or so that there's been a slowdown in consumer purchasing of new vehicles. Lots have been building up some. So as we know, auto loans are a big part of what credit unions do, used and new auto loans. Credit unions are big players there. So stagflation could definitely hurt that. I say stagflation, higher inflation. The other part of the higher inflation is, do we hit a stagflationary period? And that's a big unknown. What I'll say is usually stagflation is higher inflation and low growth. But GDP has been pretty high right now. The last quarter, over 3.5%. Projections for the next quarter over 3.5%. Projections for the first quarter or second quarter of next year over 3.5%. So we do have some strong economic growth. There's a lot of talk that these tax cuts that were enacted earlier this year, a lot of people will see higher tax returns. Not a lot, but some people will see higher tax returns early next year, especially the people that get tips, people on Social Security. Those people will see it in tax returns. So that could be really positive for the economy. So if we do have higher inflation, it could be because there's more money out there. There's been talk about rebate checks. That would certainly lead to higher inflation. The hope is that we don't have higher inflation. That'll be the one scenario that will be more challenging for credit unions to work through. It's going to be more because the consumer, their members are going to be more challenged. Those folks that are paycheck to paycheck are going to have more of a trouble. Delinquencies are probably going to increase. So credit unions are probably going to have to focus more on, collections or working out payment plans for their members, whatever their strategy is. But there'll have to be some help there because, as the essentials get more expensive, it's going to be more challenging for them to pay their bills, the members. So Of the three scenarios you outlined, certainly the soft landing would be preferred by everybody, but the mild recession is not going to be insurmountable for credit unions. They'll continue to still should be able to continue to do well. Rates are still relatively attractive right now to invest. So
Yeah, you mentioned cost of goods. I mean, I just bought all the supplies for my holiday baking, and it's just crazy how much more just those ingredients are compared to last year or the year before. Just your standard stuff, eggs, flour, butter, sugar, all of those things. It just significantly more.
yeah.
So, Tim, can inflation, interest rates, and monetary policy achieve our goal of a stable soft landing?
I think absolutely. I mean, you just heard Scott talk about the scenarios. I mean, where exactly do we go is hard to predict. But in my head, and look, Chair Powell has been taking a lot of punches from all over. But when you look at how things have formed out, I mean, I would argue that he's achieved a relatively soft landing in one of the most challenging times that we can remember. I mean, you look at what we did to the economy during COVID and the wild swings that we had as we worked our way out of that. And, the Fed has been able to engineer an economy where they brought inflation down. You know, has been running, in the upper twos. Certainly not to goal yet, and they're still working on that, but still relatively tame inflation. Um, Employment numbers have held up. Employment, I know last reading ticked up a bit, but still, I think it was 4.4%, if I remember correctly. When we were riding unemployment down from the Great Recession, below 5% was considered full employment, and everybody was happy. So, I mean, you look at the numbers and you look at what they've been able to engineer, and I would say it's been a pretty soft landing from a rather tumultuous time during COVID. Will they be able to sustain that is the key, and I think certainly they have. Um, but again, talk about curveballs. You had unprecedented tariffs that come out. What effect are they going to have? Certainly they haven't shown up like I think folks had initially thought. Um, what's going to happen going forward? It's hard to tell. But for now, I'm giving Fed chair a golf clap on a soft landing, quite honestly. And I think the guy deserves a lot more credit than he's gotten for what the Fed has done to shepherd this economy through some unprecedented times. But that's just one person's opinion. So,
All right. Well, thanks, Tim. So you were mentioning tariffs. So Scott, my next question, what impact have trade tariffs had on our economy, inflation, and employment?
Yeah, so there's been a lot of debate about the impact of tariffs, and depending on what side of the aisle you are politically, you have a different argument. So, and I think actually too, the San Francisco Fed they did some research into this pretty recently about the impacts of inflation, or excuse me, of tariffs on inflation and on the economy, and I think from their standpoint, it was mostly on the inflation front. And this has kind of been the Fed's crutch for the last little while on why the one group that's concerned about inflation, they frequently throw out the tariff aspect, and we don't know what the impact of tariffs are going to be yet, or we haven't seen the full impact yet. So there is a lot of debate about tariffs and how they've impacted the economy and inflation. Uh, it's hard to know if there's been a big impact on inflation. I would say that certainly there has been some, but it's been somewhat muted. There's been some research on who actually is covering the costs of tariffs. Is it the producer? Is it the middleman that, like the Walmart or whoever that's selling the product, or as well as the consumers that are buying it? And then I think the short answer is it's been kind of split between a lot of these different areas. So the consumer hasn't felt the full brunt of that. So the producers absorb some of the costs. The retail establishment, the Walmarts of the world and the Amazons have taken some of that, and the consumers a smaller portion. If you broke it down, maybe 20%, maybe less. So the impact on our on us as consumers hasn't been as heavy as we all thought going in. Everybody thought they would pass all these costs on to us immediately and fully, and that hasn't been the case. So that's a positive thing. Um, the concern is there could be more to come, right? There's some foreign manufacturers, maybe about, let's just take automobiles as an example, that maybe haven't increased prices this year. They've kind of held back. They've been paying more. They've actually paid tariffs. And let's assume that the Supreme Court decides that these tariffs are legal, or there's no other method too, right? Because that's still being debated by the Supreme Court. We haven't heard that decision yet. But assuming that they're all legit and we continue with these tariffs, then there are, I would say, some of these car manufacturers from overseas, we could see higher prices on these automobiles next year, with the assumption that they think the consumer can handle those price increases. So we could see some higher inflation on certain products next year for sure. But I think so far the impact on inflation has been relatively muted and contained. Um, and on the economy, certainly as we pay higher prices, it means less money to spend elsewhere. But the consumer is very good about switching spending. So as we mentioned, or I mentioned earlier, GDP as a measure of the economy has been very strong. It may mean though that you're spending more for a car, so you may be spending less on travel or some other thing that you want to do. But the bottom line is we're still spending that money, maybe just not in the area we want to spend it. And as far as employment, it's hard to know. Um, there's the hope is that tariffs encourage manufacturers to bring jobs into the U.S. And we've heard a lot of that. We've seen a little bit of that, but the problem is it takes time to build a new factory, right? You can't put a factory up overnight. It does take time. But what I'll say is there's been quite a few companies that have um, talked about bringing more production to the U.S. When you talk about pharmaceutical manufacturing, auto manufacturing, and in fact, some auto companies have done that already. They have switched over to assembly lines in the U.S. And I'm thinking U.S. producers, but some Japanese producers and South Korean car manufacturers, they've talked about building plants here, and they're in the process of doing that. So um, I think on the employment front, it could be a net positive, but then something we didn't talk about here is kind of the impact of AI. How does that offset some of this too? So there is some talk that AI may be reducing certain jobs. Some companies are cutting back, so that may be an offset to the tariff increase. But the hope is that tariffs, at least some of the commitments that we've heard publicly are that it should increase employment in this country, and some of those jobs should be pretty good paying jobs, which would obviously help the consumer out.
Tim, what about lending? What is the state of lending and the housing market? What thoughts do you have about where this might go over the next year?
Well, I think it kind of depends which housing market you're talking about at this point, because I think there's probably two, right? There's the first-time home buyer
Yeah.
that is struggling with rates and home prices and is unable to afford the house right now, or would certainly be a struggle. There's the home market for um, the higher priced homes that um, certainly, at least in our area, when something comes up, it's mobbed by folks because there aren't as many houses like that coming available. I know you hear Scott talk about it. And I've had a talk with him. He said, "Hey, it might be time to downsize, but with my mortgage rate, why would I?" Right? I mean, you have people we come off an unprecedented time, 2 or 3% mortgages. People don't want to give up homes, right? Why would you give up a home at 2 or 3% and go into a mortgage at rates where they currently are? You just wouldn't, even if you do want to downsize, right? I'll keep the bigger home and the $1,000 less mortgage payment, right? Because it just doesn't make any sense. So I think, I mean, to state the obvious, where it goes is dependent on where rates go. If we can get rates to come down, mortgage rates to come down, I think that certainly does a lot. It makes it easier for first-time home buyers to get back out there and be able to afford the home. But also, what it does is may free up some inventory because folks will be willing to get out of the current home and maybe move on. So. Um, just reading some anecdotal things. I know some think that 2026 would be could see housing break out a little bit as rates come down, things free up. So, credit union land, again, we talked credit, it's kind of all over the place, but mostly I think you see that, the home equity loan has been the loan to make as people stay in homes and, work to either renovate, add on, things like that. So, I think that will still be a good part of the lending business, but we could see the mortgage market, the housing market come back a bit if we can get rates to fall. So, and that's, as we've talked about here, that's debatable at this point. But we have a new Fed chair coming in, and the one thing that's probably not a doubt is that that person will be leaning a little more dovish than the way we're looking now. So we'll see. That doesn't necessarily mean the longer end of the curve, where mortgage rates are, will work out the way we want, but we'll see.
Yeah, that leads right into my next question. So, Scott, Chair Powell's term is up in May. So who are the front runners for the next chair of the FOMC and why?
Well, President Trump has made it clear that he's not, although he's the one that nominated, and the reason Powell is the Fed chair now, he's the one that put Powell in there in the first place. He's not happy with Powell. And as we all know, it's because he wants rates to be lower, and he feels like Powell hasn't been in his corner as far as cutting rates. So when you look at the potential candidates, I think that's clearly one of the one of the key criteria. He wants somebody that will be in there that will lower rates. And I think Scott Bessent, Treasury Secretary, has made the comment that their changes are needed at the Fed on different fundamental levels. Not forget about interest rates. He feels like there needs to be some transformation over at the Fed in the way they look at things and do things. But in any event, the last week or so, they have, Bessent's been leading the search, and he was actually one of the candidates, but he kind of took himself out, and I think that's a good thing. I think he's happy in his role at Treasury. He does a really good job, I think, in his role. He's, as I've mentioned before in different meetings and things that I've been in, and he's kind of frequently he's the adult in the room, and I say that because Wall Street knows him. He knows Wall Street. You want somebody in that position that has a good working relationship with Wall Street, and he has that. The markets know him well and understand him. So I think keeping him in Treasury is perfect, and he feels like he can get more done there than he would at the Fed. So he's kind of taking himself out of the Fed thing. But just to, the candidates, basically, Kevin Hassett is one of the candidates, Kevin Warsh, Michelle Bowman, Christopher Waller, Bowman and Waller on the Fed right now, governors. Those are all candidates. There was a BlackRock individual that was a candidate also, but really they've done interviews over the last week or two. Kevin Hassett has come out as a front runner, according to the press. He's the one that, I think recently President Trump has said he knows who it is, who he's leaning towards. But we've seen this before where there's been a front runner after interviews, and then he kind of has a change of heart. The president does, and whether it's somebody in his inner circle that encourages something else, but so it could change. But I think right now Kevin Hassett is going to be the next Fed chair, and I think at least from what I've read in the press, the real reason for that is he's aligned with Trump as far as lower rates. They both are in alignment that rates need to be lower. And that's the direction they want them to go. So and listen, of all the candidates that we've talked about, they're all very qualified. They're all very capable. I think a lot on the street wanted somebody that was currently on the Fed board just because there's that comfort level and continuity. When Powell's term ends in May, that they would have that. It doesn't look like they're going to get that, but Hassett's on the National Economic Council, so Trump's familiar with them internally. They kind of look at policy on the national and international level and where we should be doing from an economic standpoint. So he's very familiar with within the White House. I think the markets, from what I've seen since he's become, the front runner status, there hasn't been really a negative reaction in the markets. But I certainly think the markets will have to take, if he's the one that's nominated, they'll have to take the point of view that it's because, Trump and he both want lower interest rates, and that, whatever the Fed decides to do in December, to, cut rates or be on hold. Certainly come May, if he's in office as the next Fed chair, the bias will be, more rate cuts coming. Again, we're going to continue to have a divided Fed, so it's not going to be an easy task for sure. Um, just because he's in there. The other thing I'll mention is Powell could stay on. His term as Fed chair is up in May, but his term on the Fed, I believe, has a couple more years to run. So he could stay on as a Fed governor. Traditionally, that does not happen. They normally step down, but he could decide to stay there, and that would kind of further complicate things. I don't think he. Well, I don't think he will. He's been very silent on that. I suspect he'll be like everybody else. He's had a nice run at the Fed, as Tim mentioned. He's kind of weathered some pretty challenging storms here over the last few years. So, um, not a bad thing for him to kind of hit the road and say, "Hey, sayonara, I did it. I did what I needed to do. Economy's still humming along." But so anyway, right now Kevin Hassett the front runner. Somebody will have to leave the Fed for him. So if Powell stays on, then somebody else is going to have to leave. So it may mean that it's just a one-for-one change for President Trump as far as people that have a bias towards cutting. Marin would be the one that would be the obvious choice to step down. So it becomes a challenge if Powell does not step down, even if Trump gets the person in there that he thinks will cut rates. So
Yeah.
it'll be exciting. We should know for sure in the next month or so.
Okay.
They should make that announcement sometime late this year, early next year.
All right. So Tim, out of these candidates, who do you feel would be better for our credit union industry?
Jamie, I think that's, yeah, I guess first I would say, we don't think of the Fed, like we think about, which senator would be better, which representative would be better because of having pro credit union views or not, because, they're not a political institution, right? They're not making laws. They're running monetary policy, which is agnostic to politics. Right now, you're going to have some people say that that's BS and the Fed, but that's a whole other story and a whole other talk. But assuming that the Fed is devoid of politics, then really it depends how you're positioned at the credit union, right? What you can expect, and I'm in agreement with Scott. I mean, obviously, you're going to get somebody running the Fed that is predisposed to lower rates. I mean, that is going to be a prerequisite for whoever President Trump picks. And I've heard the same thing as Scott. I read yesterday that it sounds like Hassett has it wrapped up, and that an announcement could come any day. Scott said it, and Kevin Hassett is certainly the most aligned with Trump's worldview, how he sees things, certainly aligned with him as far as lower rates. So if you're a credit union that has a balance sheet set up for falling rates, and that's what you like, that's what you want to see, you would think certainly you're going to get that if at all possible. I think what's good for credit unions is what's good for the economy, right? So what I just continue to hope, and I think that anybody who is going to run the Fed has a respect for that institution and what it does, right? And although, yeah, I mean, you're going to go in, somebody's going to be predisposed to lowering rates. I would certainly think that they're not going to go in and torpedo the economy just to lower rates, right? If the economy requires rates not being lowered or rates being risen, all of these candidates are well acquainted with the history of the Fed and its importance in not only the American but the world economy. So they're going to go in there and do what's right. Are they going to be predisposed? Sure, but as Scott said, they're all very, very qualified, and they're going to go in there and do the right thing. And so what's good for the economy is good for credit unions. One thing Scott said, and I'd be interested to hear, and Scott, correct me if I'm wrong, and I've heard the same thing, certainly reading what Treasury Secretary Besson has said, and some others out there in the marketplace, we need the Fed to step back. We need a quieter Fed. We don't need a play-by-play Fed, so to speak. Correct me if I'm wrong, but isn't this play-by-play Fed we have the result of the marketplace crying for better communication from the Fed? I mean, when we were back in the Greenspan era, the joke was, what did Chairman Greenspan just say? Because he said something that only he understands, right? So you ask the Fed to be more transparent. You ask the Fed to be more communicative. So, we see the press conference after every meeting in an effort to be more communicative. You see more Fed speak out there so the markets can get a feel for what the Fed's thinking. In my head, this isn't just because, you know, Fed bank presidents or those on the board want to hear themselves talk. They're doing what was asked of them by the marketplace, which is give us guidance, be more clear. We can't do our jobs unless we know what's coming. So that's what they've done. And now that they're out there, now we want to beat them back into the mole. Stop talking. I don't know. I mean, it just seems like typical stuff of we don't like what you're doing, so do it different. Okay, we did it different. Now we don't like what you're doing, do it different. I don't know. I mean, what do you think? Am I nuts? I mean, I know I'm nuts, but am I nuts on this one, or I don't
No,
know.
I mean, I think that's the point. I mean, Greenspan was a very, what he said could be very confusing. Now it's almost like the markets, there's no ambiguity anymore. It's like everything is pretty clear from the Fed. And I think the problem arises when you have all these different, like we have today. We have all these four Fed governors and regional Fed presidents that have contradictory points of view and is very evenly split. And then it's like, okay, where we go? And there's that confusion. But yeah, I think you're right. This came about to provide a little more clarity to the markets, a little more certainty that we're going to do. I think some of the concerns I've heard is things like maybe at this, and this is just an example, at a certain meeting, the Fed should be moving rates up or down. But because the prior meeting, they didn't kind of alert the markets that they were moving in that direction. Maybe they were more neutral. Then maybe they feel like they need to use that meeting as the pivot point and not actually make the change of direction. So it puts them another 6 weeks out. Is that a big deal? And is that true? I think if it came down to it and things were really rough, like let's say we got our jobs report and the jobs market just tanked, unemployment shot up big time, and nobody's hiring. The Fed's going to come in and they're going to do an emergency rate cut, probably intermeeting, or at the very least, if they have a meeting coming up shortly, then we know what they're going to do, right? They're going to make the right decision, no matter what they've been saying for the last, 2 or 3 meetings. When the data comes in that says we should do something, so yeah, sometimes I think the Fed gives us too much information, but it's certainly there's a level of clarity we have now that Greenspan's a great example that you used, Tim, because the way he spoke could be very confusing, and the markets would oftentimes be scratching their heads afterwards and be like, okay, what did he say? What is he talking? Those kind of things. So you can't say that about Powell. Powell has been very clear and direct. Now, sometimes he'll go off script in a press conference or something, but he's usually very focused and his words are well chosen. He's a lawyer, right? So that helps too. He's got that
Yeah,
training,
right.
but he certainly has been more clear.
Yeah, it's going a little while back to Greenspan, but I mean that's what I always remembered is everybody sitting there, what did he just say?
Uh,
And it seems like since then it's just kind of been this transition to let's figure out how to make it a little more clear for everybody. But yeah, I mean, you're
yeah.
right. I mean, obviously there's plus and minuses, no doubt. I think there's no perfect way, right? Just like anything, but
Well, thank you both for joining me today. Really enjoyed the discussion. And for those listening, don't forget to subscribe or share your thoughts. And also stay tuned for Vizo Financial's post-Fed meeting analysis with Tim's FOMC update, which will be airing next week. So special thanks also to Vizo Financial's Financial Strategies workshops for sponsoring today's episode. The dates are set for 2026. March 19th will be in Hershey, PA. March 26th will be in Richmond, Virginia. April 9th, Greenville, South Carolina, and April 16th in Pittsburgh, PA. Registration is coming soon. To learn more, visit Vizo Financial's website at www.vfccu.org. As always, thanks for listening and make it a great day.